Hello, in this video we will be going through changes in inventory methods. Companies who have inventory have a specific inventory costing method that they use, whether that is LIFO, FIFO, or weighted average, or anything else. And in general, and so when you have a specific inventory method, that's called you are following a specific accounting principle. And in general, accounting principles should be applied consistently from period to period in order to allow for the users of the financial statements to compare it period over period. However, sometimes companies decide to change their inventory costing method for various reasons. And there are very specific rules that they have to follow when a change is done. To change from one inventory method to another requires a lot of work in many aspects throughout the company, and it's not entered into lightly. So you won't see this, it's not like companies do this often. When they do it once, it's usually they will stick to that new method for a very, very long time. In this video, we're going to be talking specifically about changing in inventory methods. When we get into the second half of the year, there will be an entire chapter devoted to changes in accounting principles and how to deal with them. But there are various steps that are taken when a company does decide to enter into a change of inventory method. And when you decide to change from one to the other, whether it's FIFO to weighted average or LIFO to FIFO, whatever it is, there is you have to treat it as a retrospective treatment. However, and this is a big however, if a company decides to change to LIFO, then they don't use the retrospective method. We will use a different method, and we'll go through that later in the video. So the retrospective method, retrospective treatment, I should say, is really used for inventory method changes, except for anything to LIFO. Whether you have FIFO to LIFO, weighted average to LIFO, those will not be treated through the retrospective way. So the first way we're going to be talking about is the retrospective treatment. And what this means is that all the previous period's financial statements have to be revised as if the new method had been used all along. The company needs to calculate what adjustment they need to make for the affected accounts. Because differences in the cost of goods sold and income in the prior years roll into retained earnings, as well as income tax effects, but we're not going to be talking about the income tax effects in this video. That will be covered later in the second half of the semester in that chapter devoted to changes in accounting principles. But the differences in the cost of goods sold and income in the prior years, right, are rolled into retained earnings. So you know your inventory amount will change, and you know that your retained earnings amounts for the current year will change. And so, right, so you're going to calculate, if I had used, let's just say we're going from FIFO to weighted average. So if I had used weighted average all along, my cost of goods sold in the prior 2 years, or in the prior, actually just in the prior years in total, would have had an X dollar effect on my retained earnings. We have to record that in the current year. You also have to update your inventory, because right now in the current year, your inventory rolls forward year to year. It's under the FIFO method, and you have to revise your inventory to be reflected what it should be under the weighted average method, assuming that's what you are changing from one to the other. So that's what step one is. Adjust the affected accounts. Once you determine what that entry is, you record that in the current year. What you need to do is the company needs to revise the step two. They need to revise the comparative financial statements. So you have to look at the financial statements that they issue. They have to look at the financial statements that they issued. And when you issue financial statements, typically the balance sheet has 2 years worth of information and the income statement has 3 years worth of information. What the company needs to do is they need to go into the balance sheet and report the inventory as if they were using the new method all along. So they have to go and they revise their balance sheet. And with their income statement, they have to revise their cost of goods sold at, for the current year and the prior 2 years. So it's 3 years total. They have to revise their cost of goods sold to reflect what what it would have been had they been using the new method all along. So in the current year, they book the adjustment in their actual books, and the financial statement, they have to revise it to reflect that adjustment all along. And I just want to go through, show you a financial statement of what it means, because I think it just makes it more clear. So here, this is Apple's 10K for the most recent 10K, and I'm looking at their balance sheet right here. And you can see on their balance sheet, they have this inventory number right here, right? So they report their inventory right there for the last 2 years, for the prior year and the current year. If they were to change their accounting method, they would need to go into let's just say they changed it for this year, this September 20th, 2024. They decide to change their accounting methods from one to a new accounting method. They would record the entry in the, but when you issue your financial statements, they're going to have to, this September 23rd, 2023 column, they would have to revise this inventory number to reflect as if the new method had been used in the prior year, even though it was not. And then also you go into, they would have to look at their, let's find their statement, their income statement, which is above their statement, consolidated statement of operations. So that's their income statement. And here's their cost of sales for products, right? So that's really cost of goods sold. And you can see on the income statement, the financial statements show 3 years, and that's just typical. So in this year, if they made a change to their inventory methods, they would have to reflect their new cost of goods sold, but they would also have to change this number from the prior year and this prior 2 years to reflect that change as well. They have to report the cost of goods sold as if that change, as if the new method had already been in place and used. So once our cost of goods sold changes, right, for the prior years, that means our net income changes as well. If our net income changes, our net income flows into the statement of retained earnings, right? And that affects the retained earnings balance that is on the balance sheet under the shareholders' equity, right? So they call it here accumulated deficit, but that is the retained earnings. They would have to change the retained earnings amount reflected in the financial statements as well. So, and additionally, what they would need to do is after they revise their financial statements, they also have to disclose some additional information, and it's very specific. They have to say what the effect was, why they changed, what their change on net income. They have to disclose what each line item that was affected They have to disclose what their new earnings per share. And so there's just very specific information that needs to be reflected in that. Let's go through an example. AutoGeek Inc., a wholesaler distributor of auto parts, began business in 2024. Inventory reported in the 2026 year-end balance sheet determined using the average cost method was $123,000. In 2027, the company decides to change its inventory method to FIFO. And if had they used FIFO in 2026, their inventory would have been $146,000. So what do they need to do to report this change in 2027? Step one, they adjust their affected accounts. They need to increase their inventory by 23,000, so to take it from 123 to 146. And then the other side of that entry is the retained earnings. And that's really how the catch up happens from the prior year, because your cost of goods sold would have been different under the FIFO method, right? They're changing to the FIFO method, which means your net income would have been different, which would have affected your retained earnings. So in this situation, it's an increase to retained earnings, so we credit retained earnings. The second step that we need to do is revise their comparative financial statements, just like I showed you on the Apple 10K, to appear as if the newly adopted inventory method, which is FIFO, had been applied all along. And then the third item they would need to do is disclose it in a note to the financial statement. So here's an example of a company that changed from the LIFO basis to the FIFO basis. And this is the note that they included in their 10K. And so they said, you know, we made this change, and they tell you the reason why they made the change, which is required. They said the FIFO basis is a preferable method because it improves comparability with our peers. It harmonizes our accounting inventory across all locations, more accurately reflects the current value and physical flow of inventory, and so on and so forth. And then they also disclose what their cumulative effect adjustment to increase the inventory balance, you know. And so you can read through this, but it just gives you a lot of information that is required when you change methods. Now, we use the retrospective treatment when changing inventory methods from one to another, except when we change to the LIFO method. And when the reason for that is because changing to the LIFO method is usually it's impossible to calculate the income effects on the prior years, because there's certain assumptions that would be required as to the inventory layers and that were created in prior years. That's either very difficult or to calculate or impossible. Is why when changing to the LIFO method, it just uses the prospective approach, which is a different approach. And in that approach, basically you make your adjustment in the current year. You record your adjustment in the current year, whatever, you know, your inventory would be if the LIFO method is used, and you make no changes to your prior year financial statement. So you don't have to like restate them, but you do need to disclose it, right? You need to disclose that you made the change and certain reasons. So here is another example of a disclosure, and it includes the nature and justification for the change. In this situation, the company decided to change from FIFO to LIFO, and it said because of the high inflation environment the company is experiencing, the company believes that the LIFO method is preferable because it better compares the cost of current production to current revenue. So in times when prices are rising, this will be the result of LIFO. Your current cost of sales has better matching to your current revenue. But again, you don't need to change your financial statements, you just need to disclose it. And then it also states why they were not able to retrospectively change the financial statements, and just saying that it's basically impossible to calculate. They do, however, say what their current year change is. They said that they need to reduce their net earnings by $37 million and that their earnings per share changed. So there's certain things they need to disclose. Okay, let's do this example. In 2027, the Belger company switched its inventory method from average cost to FIFO. So we know we're going to use the retrospective treatment. Inventories at the end of 2026 were reported on the balance sheet at 55 million. So I like to write everything down, 55 million. If the FIFO method had been used, the 2026 ending inventory would have been 50 million. So it would have been reduced, right, by $5 million. So ignoring the effect of income tax, the adjustment to the 2027's beginning retained earnings would be what? Well, if my inventory was reduced, right, it would have been reported lower by $5 million. That would mean I would have to credit my inventory by 5 million, and the other side would be debit to retain earnings. And a debit to retain earnings means that it's being reduced or decreased. So the answer should be D, correct.